in at least one of the two congressional institutions, whether it be the House or whether it be the Senate. So the past four midterms, you've seen the D flip to an R or an R flip to the D in at least one of the chambers of Congress. So you don't have to be a big fortune teller to say, well, if that's kind of the general pattern, perhaps we would expect to see that. And certainly there seems to be some tea leaves out there that would suggest that the House may very well be the one that flips from an R to a D. Usually midterms are very good for the party that has been out of power. Now, here's a deeper dive on some statistics for the midterms. So, when you have midterm elections, obviously there's a level of political uncertainty that historically, looking at midterm election years back to 1962, so that would be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 14. Okay, so of those 14 midterm election years since 1962, generally there has been a sell-off early in the year. Okay, much like what we saw in February for this year. So this is kind of interesting. If you look at those 14 other midterm years since 1962, where you would see early in the year a bit of a sell-off in the markets. And then the next three quarters, so the first three quarters of those midterm election years, historically, the markets are relatively flat. So far, that pattern for 2018 seems to be holding very much with the historical numbers looking at previous midterm years. Now, here's the good news. Once it gets close to resolution, the stock market has a tendency to breathe a sigh of relief. So looking at those 14 midterm election years since 1962, for the fourth quarter, the S&P 500 index has averaged about 7.5%. So that's pretty good. If you were flat for the first three quarters and then you wind up 7.5%, then you finish the year pretty much in line with kind of the historical averages. October being the best month as the tea leaves start to get to be a little bit clearer for the November elections. October being the best month. Even further out, if you look at the returns 1 year after, we'll give you two different numbers here. So since 1962, again, looking at those 14 years of midterms, the S&P 500 index was higher 1 year after the midterm year trough. So that statistic's looking at, okay, going back to the sell-off early in the year, the low point of that sell-off within a year after that midterm year trough, average return 31%. That's a pretty good number. Furthermore, the report and the analysis that we're looking at here says once the midterm election takes place, the index has been higher 1 year later every time since 1946. So a lot of conversation about midterms. Look, folks, it's just starting. As we get closer to the midterm date of November the 6th, we're going to hear much, much more of it. Already starting here in Florida to see some of the ads. We're going to see a lot more of that. The reality is that you're going to hear a lot of the media fanning the flames, if you will, that, oh, no, it's just going to be a very difficult time. Remember the historical perspective that you heard today on the program. I am sure we will repeat it going forward, particularly as we start to get closer. But we wanted to get the analysis out to you right after we saw it, because it certainly is some interesting numbers that helps to bring it into perspective. Past 4 midterms have seen a flip. No reason to not expect that here on this one. The year so far, interestingly, seems to be following the pattern of the 14 previous midterm elections, which were marked by, number one, an early sell-off in the markets, much like we saw in February, and then the next 3 quarters basically just kind of trending sideways, and then watch out for the fourth quarter, because that's pretty much where you made most of, well, nearly all of the money for the year if you go back to those 14 other midterm election years since 1962. So we shall see whether that plays out again this year, but certainly always nice to have some history on our side, particularly with the markets effectively acing their midterm elections exam. So interesting stuff there. I'm sure we will touch on that more in the months ahead. Hard to believe that all of that stuff is less than 6 months away. It's coming right up. It'll be here before we know it. So some interesting statistics on midterm elections, which segues very well into some of the numbers we wanted to share with you about volatility and actual market performance. And every time we see statistics and numbers and things like that, it just really goes as one more piece of support for our fundamental investment thesis at the office, which is that you ain't going to time the market. The best course of action is to be consistent. We'll share with you those latest statistics that we saw when we get back right after these messages here on Dollars and Cents. This is Joel Garris, News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
So congratulations to Florida. I don't know if you all saw this, but Florida, along with Colorado and South Dakota, was recently named as one of the top 3 states for retirement in 2018. Interesting survey, looked at a bunch of different things, most importantly affordability, quality of life, weather, and the state's tax environment. But congratulations to Florida, right? And one of the top 3. Colorado, I think, would be kind of interesting, right? But I'm not sure about South Dakota. There's probably not a whole lot going on. Plus, the weather out there can get kind of a little tricky. But congratulations to Florida. Hey, we made the top 3. That's pretty good indeed. Welcome back to the program. This is Dollars and Cents. I am Joel Garris of Nelson Financial Planning. We're going to talk a little bit in this segment about volatility in the markets. And the simple fact is that despite what the media would have you think, that the market is sort of always constantly in flux, the vast majority of the time, it just kind of bounces up and down by a little bit on a daily basis. And nowhere is these statistics more strong than when you start to look at those best days for the markets. If you look, for example, over the course of the past 10 years, the top 50 percentage gain days, only one has occurred in the last 6 years. Similarly, if you look at that same 10-year period of time, the total return for the S&P 500 just by being consistent and investing and leaving it alone. Your annualized return would have been about 8.5% per year. That's a decent number. If you missed just the 10 best days over that 10-year period, so basically 1 day a year, the 8.5 annual return drops all the way down to 1.3. Stop and think about that for just a second. Okay? Looking over the past 10 years, the annualized return 8.5, just buy and hold and don't get distracted by what the media would like you to be distracted by. Missing just the 10 best day, 1 day per year takes your return from 8.5 and drops it all the way down to 1.3. Boy, I'll tell you, if there's not a stronger statistic for the wisdom of being a consistent investor, I don't know what is. It's just, there it is, right? It's pretty strong. Similar numbers, best 5 trading days. Now looking at the best 5 over that same 10-year period. So the very best days, 5 best days over that same 10-year period. Those days were responsible for over half of the total return than the other days combined. So if you take the top 5, the best 5 days over the course of the past 10 years, over half of the return comes from those 5 days. Less than half of that return came from the other 2,513 trading days in the same 10-year period. Folks, when you hear these numbers, they really do have to make you stop and think, my goodness, how am I going to know when to get in and when to get out? And the answer is you're never going to, because the market moves very quickly in short periods of time. And I think we always hear about the negative part of that, but there is, in fact, a positive side of that as well that ultimately generates the lion's share of return over time. The best way to ensure that you get that is to be consistent and to stay invested. And as much as you can, try not to get too distracted to what the financial media and the media in general would have you focus on. It is dramatic how much damage you can do to your investment return thinking that you're going to hop in and hop out of the market. It's just crazy when you hear these numbers. You know, if you look at 10 years and you miss 10 days and the return goes from 8.5 to 1.3, stop. That's dramatic. That's the annualized return, folks. That's not just the return for the particular year. That's the annualized return that literally drops to be less than 15% of the total return that you could have gotten over the course of the decade. But my goodness, all it takes is to get distracted a little bit. And when you stop and think about investing, and I think often when people hear be consistent, stay invested, I think many out there think, well, that's just far too simplistic of an approach. Unfortunately, though, there's statistics like this that say, how could it be any other way? How could you have any other approach? You think you're going to sell and then buy and then sell and then buy, and anybody that professes that they've got that discipline all figured out, well, good luck to you, because that's not what the numbers say. 10 days out of 10 years, fundamentally